On August 22, 2006, home prices in the United States peaked at a record high. Looking back at this infamous month, the housing bubble had already imploded, yet at the time it was eerily quiet on Wall Street. Nobody was aware of what was coming. What happened next would come to be known as the Great Recession, the worst economic downturn the world had seen since 1929. From that date forward, home values along with the entire worldwide economy began collapsing. First slowly, then all at once. The Case-Shiller index, which tracked home prices, would fall 32 months in a row. 5.5 years later, it would eventually bottom out, resulting in what was once believed to be impossible, the complete destruction of real estate in the United States. Now in 2023, many are predicting a crash of similar magnitude. One that could shake up the market and change everything we know about real estate forever. But I know what you're thinking. You're probably assuming this is just another YouTube doom and gloom piece intended on stirring up emotions and most importantly, gathering views. Fair enough. But before you dismiss this historic housing crash as an impossible outcome, hear me out. The deniers are right in one aspect. There is no one rejecting the fact that right now home prices remain elevated and outrageous. Looking at strictly values, the deniers are right. There is no crash. Following 2020 and even before that, values have been going into the stratosphere, pushing the American dream further and further away. In fact, measuring today's fall, which according to the latest Case-Shiller reading is minus 3.07%, you would be correct in saying that this is nothing more than a minor correction. So where is the crash? This isn't even close to 2008. Well, the answer is hidden in an avalanche of data that is typically referred to as leading indicators. The crash is coming, and to understand why, you have to understand some simple principles in regards to economic measurements. We know from last time that it took the Case-Shiller 2 full years or 24 reports to show that things had fallen 10%, which by the way wasn't even halfway to the bottom. That means that someone at this point in time would have said the same thing about the '08 crash as this one right now. Things are not that bad. Why is everyone panicking? Like I mentioned earlier, the Case-Shiller is down 3.07% from the peak, which we saw in June. For 5 straight months, it has experienced losses, and if we compare that to the infamous 2006 summer, we can see that this downfall today is actually worse than what we saw in 2006. Now the question would be, well, how do we know if this continues? And of course we don't know for sure, but there are various reliable leading indicators that give us a clue that this isn't just noise on the chart, but rather a trend reversal that's signaling one of the worst crashes ever. We know from other research that volume leads price, which is essentially saying that if the number of sales declines, we can expect prices to come down as well. In 2005, we saw exactly this happen. New home sales fell 33% from the peak in July of 2005 to December 2006. By this time, it was apparent that something wasn't right in the market, and new home sales had shown this troubling development nearly 1 year before prices on the Case-Shiller peaked. Today, we see that home sales peaked in August of 2020, and they are down 38%, similar to what was happening in the '06 bubble. Except this time, to make matters worse, mortgage rates are on the rise, meaning that not only are we facing a reversal in the new sales market, we are doing so in the face of rapidly rising rates and an overall economic downturn. From that period in August, the average 30-year mortgage in America has went up from 2.88% to 6.48%, which represents a 125% increase. As far as I can tell through my research, this has never happened this rapidly in American history, and there's reliable data for rates going back to 1970. In fact, according to Don Johnson on Twitter, this is the fastest market decline during a Fed tightening cycle ever, and it doesn't even come close. We are only 8 months in since the Federal Reserve decided to raise rates, and according to history, the average tightening schedule is just under 2 years long, meaning that historically speaking, we aren't even halfway done with the Fed squeezing the economy. Now, if we steer away from those stats produced by various government entities and look at private companies with massive data sets, you can get an even more accurate look at the current damage and also a more accurate expectation going forward. While the Case-Shiller and all the other various government reports are accurate and provide quality information, they're often published with significantly delayed data using methodologies that tend to downplay the volatility. Companies that have a live look at the current marketplace using cutting-edge technology can often provide a deeper look into what is happening on the ground right now. One of those companies is Redfin, and they put out great reports weekly on their website that anyone can access. The latest data shows more troubling information that can help us understand where the major indexes are going. For example, like I mentioned earlier, the Case-Shiller is down just 3.07%, but according to Redfin Data, the median house price in America has went gone from 399,000 in June to 350,000 as of June 1st, 2023. That's a 12.2% drop, which is more than 4 times worse than what the Case-Shiller seems to be indicating. This likely means that we're going to see these numbers slowly appear in government statistics as time goes on, and we can always look to Redfin for a more up-to-date outlook. One more thing you can look at is the big red button below this video. It would help out tremendously if you could take a second to like and subscribe. We are at 136,000 subscribers, and I would love the channel to hit 140 by the end of this month. Now back to the video. Now, if we only rely on these numbers based on the Redfin data, we can safely say that we are already in a massive crash. Annualized, this rate of decline that we have seen is suggesting that by the end of 2023, the median home price in America will drop to $315,000. That will bring us close to the numbers we saw at the end of 2020 and will result in a 21% decline from the peak. Now, the interesting thing about this stat is that even if it were to happen exactly as I just suggested, it actually wouldn't change affordability as much as you think. You see, the average mortgage payment has already skyrocketed to $2,500 a month, and back in 2020 it was $1,300. For this average to come back down below 2020 numbers, homes would need to break the all-time record for price declines. This is because rates have significantly increased, and despite price cuts, mortgage payments have failed to respond proportionately. If we look at a graph going back to 2015, you can see that for the average American, the new housing market has completely changed. Payments are on a different planet compared to 10 years ago, and this is all part of the reason as to why so many are bearish regarding the future. Now the number one question is what will ultimately cause the downfall? We know that in 2008 the subprime crisis was to blame, but today this isn't a problem. Today we have a different issue that is seldom talked about or even acknowledged. It's the housing investment bubble. Everyone wants to be a landlord, and it's understandable why this is. Over the past 15 years, home prices have done nothing but go up, and due to some amazing lending standards in the United States, it was possible to secure a 30-year mortgage with a very low rate for minimal money down. There were plenty of people borrowing hundreds of thousands of dollars to buy homes that year over year rapidly appreciated and allowed owners to essentially create ATMs out of their homes. For example, a common strategy called for the purchase of a duplex at 3.5% down, rent it out for a couple years, watch it appreciate, take a HELOC loan on the rise in equity, buy another duplex, rinse and repeat, and now you can realistically have a multi-million-dollar portfolio with very few dollars to put down. This created insane cash-on-cash returns and fueled what many are calling the amateur investment bubble. Twitter accounts like Housing Bubble Disrespecter may sound like a joke to many, but they offer some pretty reliable stats that seem to indicate that we do indeed have a serious problem with real estate, as we have been trained to believe that it's the guaranteed way to millions. For example, the subreddit Real Estate Investing has seen its subscribers grow from close to 0 in 2018 to nearly 1.2 million. And you have to ask yourself, why are there over 1 million Americans who are interested in buying more than one house for investment purposes? Even videos like the ones I make can get over 1 million views, showcasing this rising popularity. I find it baffling that there are millions of people interested in watching videos related to advanced home price statistics, and I believe this is all feeding into this inflationary home bubble that realistically started following the Great Crash in the mid-2000s. My next upload will outline this amateur investment bubble in detail, but this is my theory on the source of this next crash. The home was never meant to become an investment vehicle or ATM to fund your next boat or Ford Raptor. It was simply meant to be a place to live. Today, the residential real estate market has been converted into a financial playground where amateur and professional investors compete for ROI, taking over neighborhoods and even entire cities. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know in the comments below if you agree that real estate investing has gotten out of hand in recent years, resulting in a complete change within home markets throughout America.